All right, welcome Real Estate Hustlers podcast. I'm your host, Josh Appleman, founder and CEO of Appleman Capital. Today we're joined with Andrew Cushman. Andrew is a former chemical engineer. Andrew has transitioned from flipping homes to syndicating multifamily properties, managing over 2,700 units, also a ski instructor and a surfer. Andrew enjoys family time and the outdoors adventures. Andrew, we appreciate you coming on the show today. If you could, tell us a little bit more about yourself.
Well, yeah. I mean, you got the short version there. I always knew I wanted to be an entrepreneur. I didn't know how to do that, so I figured I could go be a chemical engineer and at least have a decent job. And did that for 7 years. Discovered house flipping here in Southern California. That was profitable, but also kind of like having another job. And in 2010, we said, "What's the next big thing?" Well, we had a big recession, so probably meant a big expansion. Half the people had lost their houses and couldn't buy one, or were too scared to buy one. So that means we probably, no one can buy a house or wants to buy a house, and a growing economy probably means the rental pool is going to be really strong. And so we hired a mentor and learned the apartment game, and have been doing it full time since 2000. Full time apartments since 2011, and like you said, we've done about 2,700 units. It's been a really good business.
Yeah, and that's and you started where everyone else starts at, which is basically zero, and then you learn from there. You learn from one transaction to two transactions to three transactions. At what point? What was your volume like on flipping that told you need to get to the next phase?
So we were in Southern California, and when I say we, I'm generally referring to my wife. She's my business partner. It was just the two of us flipping. So we weren't like, now you have guys that have like 7-figure flipping companies, and it's a serious business. It was just I was the guy making phone calls and knocking on doors. So we might flip 5-6 houses a year, but also we tried to go, because we knew we were going to be low volume. We tried to go really high margin, and so that balanced out pretty well for us. So yeah, that we weren't huge, like doing 100 a year or anything like that. We were doing like 5 or 6 a year. I think all in all, we did maybe 30 or something over 4 or 5 years.
Got it. But the time is of the essence, and I guess you figured the time you bought it, the time you renovated it, the time it took to sell. That process is what takes forever to get done. So time, you need more money for it to make sense too, versus going and buying, say, a 10-unit apartment complex where you can flip 10 houses in one building and then keep it or sell it off.
Well, and that was one of the many factors that drove us to move to multifamily. Was is just the scale of it. Would you rather flip 100 condos separately all over a large city, or get an asset where you have 100 of them on one parcel of land and 12 buildings or something like that? And of course, yes, it is a longer timeline. You're not going to turn around a 100 unit apartment complex in 6 months or a year or something like that, but it's far more efficient. And when we were flipping houses, we'd sell a house, make some money on it, put that in the bank, and that was great. But like, you're back to zero. You got nothing left to show for it. I mean, again, I'm not minimizing the fact that it can be a good profitable business. It's a great step. But what we decided is, like, okay, we want to grow something that, yes, produces those equity chunks, but also has cash flow and builds lasting wealth, and something that is a little less transactional and is longer term. So.
Yeah, I totally agree. It's building up your consistent revenue, but you still have bills you have to pay. So you're wanting to build up your rental portfolio, but you have to meet the obligations. So did you keep flipping houses while you were trying to learn syndications, while you're building up your portfolio?
Yeah, that's a really good question, because a lot of people, you hear different things, like, well, do both at the same time, or burn the bridges, and it's kind of confusing. Like, okay, well, what should I actually do here? I tend to be a little bit more on the conservative side. So when I transitioned from my job to flipping, and then from flipping to multifamily, how we structured that is, when we started the flipping business, I was still working full time as an engineer. I didn't quit until we sold the first flip. And then we made as much as I made all year at my job. Then I quit my job, and then it was similar when we transitioned to multifamily. Is we continued flipping at a lower volume for maybe a year and a half. until we got into the second multifamily deal. And then we're like, okay, this is going to work. This, we see a whole lot of potential here. Now we're going to drop the flipping and move full time into multifamily. So some people just go, again, burn the bridges, jump, or as Reid Hoffman likes to say, jump out of the airplane and plane and, build stitch together a parachute on your way down. I'm not quite that adventurous. So, we kind of transitioned it a little bit.
Yeah, I'd say, well, it's conservative. That's you still have some safe havens put in there. So you decided to get into multifamily. You got a mentor, and then I'm assuming that you started to learn how to underwrite, learned the language, learned the lingo. At what point did you finally find your first deal, and then what did that look like?
So our first multifamily deal is exactly what I recommend that everyone not do. And then again, this was 2011, so very different time than we are now. It was a 75% vacant 1960s, 1970s neglected apartment complex in Macon, Georgia. It was 92 units. And just to give you an idea of how rough it was and the pricing at the time, we paid $7,500 a unit for
Wow.
that property. So
That's that's wild. I don't know if we'll ever see 7,500 unit per unit again, at least unless there's a major event.
you know what? I hope not, because that probably means something really bad has happened.
Yeah, yeah, for sure. So tell us. So you bought it it sounds like a great basis, but with that great basis, it sounds like it came with a lot of opportunities.
That's a good euphemism for it. Yeah, opportunities. So it gave us opportunities to learn how difficult renovations can be on a very old property. Gave us opportunities to learn how certain neighborhoods can make asset management that much more difficult. It gave us opportunities to learn of what kind of the older properties you buy, the amount of headaches that you're signing up for go up exponentially. And so and then also managing that stuff from across the country, that was actually one of the reasons we went straight to our first deal was 92 units, is because we wanted something big enough that would support on-site full-time employees, because we knew we were going to manage from California, and this is in Georgia. It was very difficult. So, when I tell people don't do this, what we did is we bought a C minus D plus property in a economically declining market, and none of those things are something you want to do to be a good long-term investor. What I would do differently is just buy a slightly better property, in meaning you hear people say about A class, B class, C class. C and D is the rough stuff. B is kind of the workforce, and A is really nice to simplify it down. I would actually go straight to B. Because when we look back over the last 15 years and 2,700 units, the highest profits with the least headache was actually all our Class B stuff. But getting back to that first deal, the biggest thing is that we did it, because I probably wouldn't be talking to you if we hadn't just jumped and actually just done something. And it did work out. I mean, so many things did not go to plan, but we did end up selling it. We refinancing it. Then we ended up selling it for multiple times what we paid for it a few years down the road. So it was a profitable deal, but it was very well earned, I guess you could say.
Sounds like being in trenches the entire time, just figuring out the next fire to put out.
Yeah, that deal is part of why I'm so great now. So
that can happen. I mean, that's when you first take over a property. Let's ask this: when you first purchase a property, what does that process look like when your takeover process?
Yeah, so how it works in apartments is in single family you make an offer and you kind of maybe go back and forth a little bit. You sign the agreement and then it closes. In multifamily, first you submit what's called an LOI, or letter of intent, and it's basically a kind of a summary of your offer. Like, hey, I'm going to offer you this price, and we're going to try to close in this many days, and there's some other stuff in there, but it's a letter of intent. It's not binding. and that usually ends up getting negotiated. And then if you agree on it, then you go to a PSA, which is a purchase and sale agreement. That is your legal agreement to buy the property. It can take, I mean, I think the fastest I've ever had one done is 3 or 4 days, and I've had those take 2 months because everybody lawyers up, and then they got to argue over everything, and those things will be 30, 40, 50 pages long. And so what we do is during the process of negotiating that purchase and sale agreement, we try to do as much remote due diligence as possible, meaning we're diving super deep into rent comparables, the health of the market, new construction, crime, just all the things that can affect the performance of a rental property. And then the minute we sign that agreement, we will actually show up with a team of people. It could be 8, 10, 12 people, depending on the size of the property. Now, in that very first deal, it was me, my and like a couple of inspectors and a few other people that I roped into it. So don't anyone listening, don't feel like you can't do due diligence without 10 people. It's just it grows as the assets get bigger. So as soon as we sign that agreement and we are legal, we have a legal contract to transact, we show up with our team and a bunch of contractors, and we try to look at every aspect of that property. Somebody reads every single lease. Even if there's 250 leases, someone actually reads all 250. They sit in the office and they do that for a couple of days. We look at the wiring, the roofs, the windows, the foundations, the landscaping, every physical thing we inspect, and we also go inside every single unit. So if you're buying a fourplex, go inside all 4 units. Do not accept an excuse. Oh, we lost the key, or oh, she won't let us in, or the one unit you don't go into, that's going to be the unit that's an old meth lab that no one told you about, and now you got a serious problem, right? So even if it's 300 units, we will walk every single one of them. And again, we're doing this with contractors and all kinds of different people, and we put together that lets us fine tune the business plan for, okay, here's how much money we're going to need to spend on this. The seller originally told us the average rent was $1,000, but we just analyzed all the leases, and now we know it's actually $965. There's a huge long list, but that's kind of a quick summary of it.
Yeah, that's part. So that's the due diligence part, and then you finally close on the property, and now you get to find out who the bad actors are, who they're typically the drug dealers, the ones who don't want to pay rent, the ones who have the excuses. That's where it gets really fun. This is the first couple months of the close, and then you're going through a reposition at that point, regardless. I'm sure you underwrite into variance of what the rent roll says we're bringing in, and then what it actually is, the effective rent roll. What is your process after you actually close on a property?
And actually, I would say, you mentioned the cleaning out the drug dealers and all that stuff. That is true. I have done a whole lot of that. That is the stuff that you deal with in Class C or lower.
Oh yeah.
If you do go to Class B or even maybe A minus, you will deal with far less of that kind of thing. I see. So Josh, you asked about what the process was after we close.
And if it's a Class C in a B area, those are usually the hidden gems too, where you can reposition the complex, get it to where the neighboring properties appreciate what you're doing, what you've done.
Yeah, you're exactly right, and that is where some of the biggest value add is if you find a property that, due to usually owner neglect or something along those lines, is far below what it should be for the neighborhood. If you go in and put in the expertise and the work, that's where you can make a lot of profit, especially in multifamily. One mistake, though, that I see really common is, I think it's just optimism, maybe, but is people buying a C property in a C neighborhood and saying, all right, we're going to turn this into a B. It doesn't work that way. You can't take the property above the neighborhood. It's got to be the other way around.
Yeah, 100%. But as far as like when you purchase the property, and then you're working with third-party property management, correct?
Yeah, so we use third-party property management. That's an ongoing debate. Do you manage yourself? Do you use third party? We could do a whole podcast episode on how you make that decision. But what we do is really kind of a hybrid model where we do have a third party property management company that we've worked with since the beginning, but we very very closely asset manage them. And we have a couple of employees on our team that typically would be property management type people, so and they help us kind of integrate. So we do use third party because I don't, if you're going to be an investor, you really don't want to be dealing with the fact, the argument because the lady in 3C lets her dog bark at night, and the guy in 4B is really pissed off because it pooped on his front patio. Like, eh, filing evictions, all that kind of stuff. That kind of routine admin, high headache stuff is, for us anyway, is best left to somebody who specializes in that and just has built the systems for that. And we see ourselves as investors. And so we want to really closely manage them as they do that. And then we're looking at bigger pictures of, new markets, new assets. When do we buy? When do we sell? When do we refinance, etc.
Yeah, that's huge. And property management has so many different components to it, to where if you have somebody just kind of tapping on the shoulders of somebody else, it keeps everyone in line and keeps your property performing. What do you feel like your highest and best KPIs are to make sure that the property stays on track?
Um, it depends a little bit on what stage the property is in, if we're in the position of repositioning it or if it's already stabilized. Um, but I would say, as an investor, your number one thing is net cash flow. One thing I see a lot is in net cash. So you have in multifamily, you have net operating income, and it's just all of your income minus all of your operating expenses. So it gives you the net of those two is your operating income. However, what's a bit tricky is that doesn't include CapEx or capital expenditure. So if you put on a new roof that costs $20,000, that doesn't get factored into the net operating income. It gets factored in what's called below the line. And so you'll see a lot of properties, come up for sale or whatever. Or if you own it yourself, you're not paying close attention. You're like, wow, I'm doing great. My net operating income is, $10,000 a month. But then you look down below that, and when I mean below, it's below the line on the spreadsheet. They say, oh well, we're spending $12,000 a month on roofs and appliances and countertops. That doesn't get shown there. So you may have a property that looks profitable, but in reality, you're losing money because that capital expenditure money, yes, it doesn't show in the net operating income, but it still comes out of your bank account. So that, like, if there's one metric to boil it down to, it's the true net cash flow. And then, but beyond that, you can get into things like, occupancy. These days, we're real big on renewal rates. We want to see 75% of our residents renew and stay in the unit, because then we don't have to clean it. We don't have to fix it up. We don't have to, have vacancy. We don't have to spend marketing efforts or money, or we don't have to spend money on marketing effort. So we have, those. And then part of what we do is we tie managers' compensation to the net operating income, so that as they make the property succeed or help the property succeed, their income goes up. But again, if I were to boil it down to one, is true net income, and then revenue and renewal rates and occupancy and all the standard things that you'd hear on any kind of real estate podcast or book.
Got it. You all are when you all buy properties, you've got a CapEx budget. I'm assuming it goes along with the purchase.
Yes.
Is that something do you let the property management manage all of the renovations, and you all are managing those as well alongside of them, or is that another third party that comes in and does those?
Yeah. So we basically manage it in-house, but we lean on. So the property management company that we use has an insight kind of renovation team. But what we do is we have them. They have really long-standing relationships with lots of contractors and vendors. So what we typically do is we lean on them for getting the bids. So like, let's say we need a new roof. Well, okay, you know, Christian, can you please get 3 bids on replacing this roof? And okay, they'll go do that. Then they send it to us, and then we'll make the final decision on okay, who we're going to use, how much we're going to pay, and then when we're doing major renovations, like you just bought a property, and maybe Josh, it's the example you said of trying to take a C to a B, and you got a lot of moving components. Again, we will lean on them, the property management company, for kind of simple things like getting bids, and we certainly get their advice. Like, hey, if you guys own, if you guys manage 5 other properties in this market, is what are you seeing? Are you getting rent bumps for putting in granite, or is laminate good enough, right? So we'll get a lot of their input, a lot of their advice, but we actually manage the renovation ourselves because we found it tends to go a little bit better with a little bit more accountability. And then also, most management companies charge 5, 6, 7% renovation management fee. And so what that means is if you're going to spend $100,000 renovating your fourplex, well, that management company is going to want $7,000 on top of that cost for if they're going to manage it for you.
Yeah, and then plus you'd have some of the various expenses going out for this and that. Um, you've got 2,700 plus units, so you've seen the good, the bad. You've been in some, I'm sure, some interesting deals. What has been one of the most I'm going to say learning lesson deals that you've had so far?
Well, one is definitely that first one that I told you about. Um, the second one is the worst syndication that we've ever done. And this was early on. I want to say 2013. We bought a 348 unit C minus property in a maybe C. In reality, I'd say C minus neighborhood of South Dallas, and we had a renovation budget, and we would renovate units, and we would get a nice rent bump. But then the demographics were so challenging in that neighborhood that people would move in, stop paying rent 6 months later, and then once we get them out, they would destroy the unit. And so we couldn't just clean it and paint up, do paint touch ups. We'd have to renovate the unit again. And so that property just sucked up cash far more than we anticipated, mostly again in capex and repairs and maintenance and just uh, ongoing costs. And then again, being in a rough neighborhood, we had somebody climb up under the roof of the leasing office, knock out the skylights, and throw Molotov cocktails into the leasing office and trying to burn it down. They didn't burn it down, but they did do $30,000 worth of fire damage. That property also had what's called a chiller system, which is these are common in places like Texas and some other parts of the South, where the entire property is basically on one giant air conditioning unit. Well, guess what happens when it's August? If you're in a low-income neighborhood in Texas and the air conditioning goes out on all 350 units at once. People get cranky and mad really fast, and you're a lot of people in tight quarters. We had all kinds of stuff going on. I used to keep disappeared a small piece of metal on my computer tray as a reminder that we would never buy that kind of stuff again. And what that was a spent bullet that I pried out of the drywall walking a unit one time. So like that property, and what happened is what the end result was is after a couple of years, we said, well, we still think we can turn this around. But in 2015, everyone thought a recession was coming in 2016. And we said, well, in a recession, these kind of properties get even worse. And we did not want to risk losing money. So we just sold early, made a very small profit, and said, we're going to move on to better stuff. And so we've never bought anything like that again. That was the toughest deal that we ever did. It was large, it was old, neglected, so many difficult things with that property. But if I look at all of the, a lot of the super successful deals after that, those deals were really successful because of the things that we learned not to do on that big one that I just mentioned.
Yeah, that's huge. Well, and that goes. I guess those properties just keep retrading. Is that until somebody's keep this bottoms out at some point? Is that fair?
Yeah, they they just want, they just cut just some the broker or the owner just looks for the next overly optimistic investor, and tries to gets them to buy them. Well, so yeah, what's interesting, Josh, is those properties tend to take two paths. If they're in like gentrifying neighborhoods or neighborhoods that are getting better, then what happens is people tend to come in and do like major renovations, and the properties actually get better. I mean, you'll go to some cities and they'll be like 1940s apartment complexes that the rent's $3,000 a month because it's in a nice area now and somebody's really fixed it up. But then the other side, which is probably what would happen to this property eventually, is it just becomes functionally obsolete and either becomes really bad or gets demolished or something like that.
Yeah, that goes to show though, like you had mentioned earlier, you can change a property, but you can't change the area, at least unless it's gentrifying, and that's a whole another time horizon on itself. But it just
Hmm.
takes time to get there. For the listeners, what would you recommend the path be for somebody who wants to get into multifamily?
So what I would recommend is, number one, don't try to time the market. Like that doesn't work. I mean, yes, you can get an idea of some big cycles. Like, in 2010, it was kind of obvious. Like, okay, it feels like we're near the bottom. In 2021 and 22, it's like, okay, it feels like we're pretty much near a top. But you can't time it exactly right. So my first recommendation is, if you're going to go into multifamily, and it's going to be a longer term thing, meaning you're not just looking to flip something in 2 or 3 years, which I would not recommend trying to do right now. Start now. Don't, by the time that you wait for multifamily or any investment class to be popular and everybody's talking about it, and everything's pointing to up and to the right, you've missed the boat, because that's when you've got 10 million other people trying to do it, competing against you. That's when it's super hard to find deals. And that's when you're going to pay way more. And that's what, the people who did that in 2021 and 22 are all the people who are in trouble right now, particularly in multifamily. So number one recommended is just go ahead and get started. And if you buy a property today and it's in a growing submarket, meaning population and job growth, you manage it well, you properly capitalize it with, set aside enough money for repairs and, capex and all that. You put the right debt on it, meaning you don't get a bridge loan or something that has to be paid off in 2 or 3 years. So maybe something that's 7 or 10 years. And you manage it well, that will succeed. We are going to have in about 2026 onward, we're going to have our housing shortage is going to be far more severe than it is now, and it looks very likely rents will be accelerating upwards. And I would challenge anybody who's a little scared about trying to get into the market right now, try to find an apartment owner who bought a building 20 years ago and still owns it and regrets owning that building, right? You're not, because over time, over the long run, again, buying in the right markets and managing them well, uh, I believe if you go back like 100 years, you can't find a 10-year period in U.S. history where the value at the end of the 10 years isn't higher than at the beginning of the 10 years. And the longer you wait, the harder it is and the further behind you get. So I would say, if you're truly interested in doing it, get started. If you're like, I don't even know, what to say or do, get on places like, obviously you're listening to this podcast. That's a right start. There's, read some books, listen to real estate, other real estate podcasts, go to real estate meetups, start meeting people who have similar interests. And maybe what you're really looking for is somebody who's one step ahead of you, and get as much information as you can get from them. So.
Yeah. One more note before we sign off. What are your outlook for the interest rates? I mean, we've got the 10-year that keeps going up. It's closer to 5 now. What are you seeing on that front?
Um, so I tend to operate on a probability curve, meaning we kind of say, all right, well, here's a bit, not, we don't say, we think 10 years will be at 5%. We say, well, it seems most probable that it's going to stay somewhere around 4.5 for a good part of 2024. But there's a legitimate case to argue why it could end up significantly lower or significantly higher, right? Jamie Dimon, the CEO of JP Morgan Chase, he just came out with his letter, and he basically said they're planning on the 10-year being somewhere between 2 and 8%. Like, those are massively different outcomes in massively different investment markets, right? So, if I were to guess, I would say it probably, without some kind of extra event happening, the interest rates probably don't change a whole lot this year. Could they go down in 25 and 26? Yeah, I could see that. I could also see them not going down. So I know that's super helpful to say, well, it could be this or it could be the opposite. But that's actually kind of the point, is when you're investing, number one, it is not a successful strategy to just wait around until you get a magic interest rate that works for you, because there's no such thing. The interest rates of the last 5-10 years were an extreme anomaly. We probably will never see that again. And then number two, if you look at the really wealthy, successful real estate investors that have been doing this 20, 30, 40 years, they've seen interest rates from 0 to 20%, yet they've still made it work and still made it profitable. So, again, to answer the question directly, I'm going to guess the 10-year, the federal funds rate ends the year probably not too far from where it is today. But I think everyone's way too focused on that. You need to buy investments and structure them so that they do well, almost no matter what happens to interest rates, because otherwise you'll just sit around and do nothing.
Yeah, now we're into stagflation, so it could linger, but at the same time, like you'd mentioned, real estate right now is on a discount, so take advantage of the times, underwrite it, make sure it cash flows, and just let time do its thing. Andrew, if somebody wants to reach out to you, learn more about you, your company, possibly invest with you, how can they get a hold of you?
Yeah, there's two ways really. One, I don't do social media other than LinkedIn. So I do post on there, and if you comment, that is me responding. It's not a AI bot or VA in the Philippines or anything like that. So if you want to connect and talk, LinkedIn's good. And then our website is short for Vantage Point Acquisitions, just vpacq.com. And there's a couple of tabs on there for how to get in touch with us.
Awesome. Andrew, definitely appreciate your time today. I will certainly be following you, and we'll talk soon.